Hello and welcome. This is John. Looking at the markets, as you can see in the weekly outlook, I noted that if the market makes a new high on a daily basis, we could form a divergence in the advanced decline line on a daily basis. This is the S&P 500. Let's take a look at the weekly though. The weekly, it's just starting to arc lower, and it confirms the daily that we've seen a weakening in the advanced decline, meaning not all stocks are enjoying this rally here. And so the volume was pretty good. We do have a little upturn that we normally have on a seasonal basis in July. As you can see over here, mid-July, we see an uptick, and then after the middle point of earnings season, sometimes the market can go down. Now, the market has not really been behaving in accordance to its seasonal tendencies so far. You know, like selling may go away. We have seen a little bit of move that may have come early in April. I have a longer-term cycle analysis that was looking for a high in the market by the third week of July. Now, that doesn't mean we go down in the third week of July. That just means the market rallies up into the third week of July, and it could take time for a cycle low to occur. So, in the market here, looking at the S&Ps this particular week, we have just an enormous amount of earnings that are coming up, and big names at that. Let's start off with one of the biggest names, which is Apple, then Facebook, then Amazon. If you look on your sheet, I mean, it's just one day after another, really big names. Ameritrade, so you're going to have not just some big names technology. Netflix is coming out. Texas Instruments coming out, Whirlpool's coming out, Delta Airlines. I mean, the list just Qualcomm. The list just goes on and on and on for earnings this week. So we are going to be looking at the market with a fine-tooth comb, so to speak, going through everything as we see. Looking at the NASDAQ, which we had incredible volatility. If you note that since the breakout in May, look at the daily ranges that we've seen in the market as compared to any other time period almost this year. This is a wild range. Remember, there's an old adage, and this is one thing that makes me a little cautious up here, is the AD lines, as you can clearly see, have weakened in the NASDAQ, and the rally that we've seen is on very light volume. So that very much so is a cause for concern, since a lot of these names that have driven this market higher, your Intels, your Cisco, your Microsoft, so all of those big, large cap tech names, it seems that everyone in the financial media world wants you to be long that stuff. Unfortunately, I can't concur to that, because we are seeing some major, amazing one-day wonder moves or one-week moves in some of these individual stocks. Look at Biogen and part of the biotech sector, which the NASDAQ 100 has a lot of exposure to that, and that might be why we see the advanced decline. Not all stocks in the NASDAQ 100 is enjoying gains here, but we saw last week, like SanDisk, and I'll share that with you in just a second, amazing declines in a very short order, as I pointed out in this week's weekly outlook. When I take a look at the Russell, for example, when I see the Russell from July 1st, and this is something that I think everyone needs to respect, since the high of July 1st to the low of Thursday, we're down almost 7% correction in a stock index. Do you know what would happen if we saw a 7% correction in the S&P 500? Well, let's just take a look. From the close, let's find out what 7% really is. Well, 7% isn't down here. If the S&P 500 saw a 7% decline, we would be down to this level, approximately 1830. 1830 in the S&Ps. If we saw a 7% correction in the S&Ps like we have seen in the Russell. Now keep in mind, the Russell from peak to trough was since July 1st. That's a very short order. Could you imagine what would happen to everyone's stocks if we saw the S&P 500 make a 7% correction? Yeah, we would be right back to where we were in April. Oh, but that would hurt a lot of investors, and people probably don't see that one or might not agree that it's going to happen. I'm not saying it's going to happen. I'm saying it could happen because we have one index that's just done it, the small cap growth stock index. When I take a look here, let's look at the New York Stock Exchange Composite Index. It's actually forming what I would now consider to be another cautionary situation. If you take a look at the highs, here's a shoulder, here's the potential head, and no offense, this would be the potential right shoulder. It is symmetrical in nature. In fact, the left shoulder is the same duration or width as the right shoulder. The right shoulder high is in sync with the left shoulder high, and we have a perfect neckline that we have not broken yet. So we do have cause for concern of looking at a potential head and shoulders top. When does a head and shoulders top fail? When it closes above the right shoulder's high. If you get a close over this black line in the sand, you get a daily close over that, it's no longer a head and shoulders pattern. In fact, what it turns into is a failed pattern top, and what we look for then, if we draw a trend line over this, and I expand this so you can see, if you close over this particular swing high, which is the right shoulder's high, if we get a daily close over that level, and then we're going to probably come back and make another newer high. But as it is right now, we have a setup. We don't have a trigger. The setup is a potential head and shoulders formation. The trigger is on a close below the neckline. If it is a failed head and shoulders top, the market will close above the right shoulder's swing high, which is at this level right here that I'm pointing to. Now, if you look at the New York Stock Exchange Composite Index, you will note that the advanced decline has been weakening. And the funny thing is, when we look at the NYSE, just to give you a heads up, this index contains 50% of the stocks in this are either highly sensitive to changes in interest rates or actually include bond funds. So therefore, it is kind of not one market that you can rely on entirely in its market internals structure, because it's not giving you it's giving too broad of a based market reading, because it includes bond funds. So now let's go take a look at bonds real quick together. All right, this is the 30-year bonds, and this is a weekly bar. We closed the highest weekly close in the bond 30-year market, 30-year treasuries that is, and on extremely high volume. The funny thing is that in the month of July, we see this is adhering to its seasonal strengths in the market. Typically, you rally up in July, very similar to the overall market. You have a small little pullback, and then we see a continued advance in October. Why would that be? A lot of people sell in May, go away type of feeling. They get into bonds for that 6-month period of time, and the way the bonds look and the way the knob spread, notes over bonds, something we've been watching in the trading room, and this is the knob spread right here. It has widened substantially. In fact, if you think about it, look where we are in relationship to its all-time high, 1621 in the knob spread. That was the relationship. This is back in 2012 when the bonds made their high price. So we're not that far off in the knob spread by seeing the market potentially try to test its highs, at least getting into maybe the 140 handle in the bond market. So what do the bond boys know that the rest of the world doesn't know? One or two things is going to have to happen. We're going to see either people are putting money into bonds because they're afraid of stocks up here, or the bond boys know that there's a change coming. China's been buying bonds. The Fed's not buying bonds because they're reducing quantitative easing. We have kind of a very tricky and dangerous time period here for traders, in the sense that a lot of people feel obligated to get long the market, and this is a inverse ETF that's reflects off of the small cap. This is the Russell 2000. TZA is an inverse ETF, and the reason I bring this up to you is that the Russell, as I shared with you just a few minutes ago, is down almost 7%. And then when we take a look at this index, and we can see on a weekly basis, the advanced decline weekly broke below a moving average here. Now, the on-balance volume, the reason it's pointing up is because it's reflecting the value of TZA. I'm going to change this symbol here real quick, but before I do, I just wanted to show you we had a doji and then a weekly high close doji, but now we got a PPS buy signal, which needs to be respected in the inverse ETA TZA. Let's take a look at the IWM, which is the actual index, the Russell. As you can see, we posted a low close doji, a weekly PPS signal, lower highs, lower lows, more importantly, closes below past or prior closes, and last week's close in the Russell was below past or prior lows. So, quite frankly, now that you take a look at this Russell on a weekly basis, it was down on heavy volume, it was down on liquidation. The advanced decline on the weekly basis does confirm that. So is the market, healthy here? Well, when the Russell, which is growth stocks, is down, and I don't know if we're going to see another week of declines. We have to monitor that, but it does give us a sense or reasonable doubts that the market as a whole is at a level where it's a safe buy. I think we're all grown-ups here and can kind of figure out things are fairly lofty, but there are some connect the dots that aren't quite working. If the stock market is so bullish, why is the Russell down 7% since the July 1st high? I'm not talking last year's high, I'm talking July 1st high. If the market, broad-based stock market, is so good, then why are the bond market and the people buying notes and bonds, and why are those so strong? And as you can see, this is the weekly chart on the 10-year notes. A very strong longer-term uptrend. It's still intact. So, there is reasonable concerns for caution here, and we need to be careful. We have earnings coming out that are going to cause these markets to move left and right, and it's a binary event. Did the market meet or beat expectations on earnings? Did the top or bottom line, are they moving 5% up or down, or is it going to move 20% up or down on an individual stocks? And we've seen that kind of stuff on a lot of these stocks, folks. It's really amazing. So when they say there's no volatility, there is volatility. It's just volatility is on individual stocks. Now, I want to take a look at another market here for us. And this is feeder cattle, which while feeder cattle has seen a daily decline, we take a look at it weekly, we just, for the first time ever, except for way over here, formed a weekly sell signal. Now, a market that moved that strong typically is not going to just roll over in one day, but we have a bearish engulfing pattern here, a PPS sell signal there on a weekly chart on the feeders, and I suspect that any move back up to like maybe the 216, 217 handle should be looked at as a selling opportunity. Another thing is, if we take out this swing low, which is 207.65, if you take out that swing low, and let's examine this level just for a bit, we're going to go over and say, oh yeah, it's in this area of consolidation. So if the market does try to rally, we want to sell probably closer to maybe 215 or so. Let's look at the weekly pivots, and you'll note that we have pivot not even that high, so I don't know if we're going to be capable of getting that high. Person's weekly pivots is projecting a inside trading week with a lower high and a higher low, but still overall lower highs. So you can see there's support on the weekly basis at 206.90, which is close to that 207. So a close underneath that swing low, and I think you got a lot more downside. Monthly pivot support is all the way back down to as you can see here, 280. So there is some room for feeder cattle prices to move lower. All right, another one, wheat. Wheat had a what we call a inverse hammer, or some people refer to that in candlestick as a false sense of security. In other words, they see the market rallied, fell off their highs. This is actually a bullish reversal potential pattern. And note that we are right at monthly pivot support for wheat. So now when we take a look at it, we are also in a seasonally strong period of time now too. So if this is a weekly chart, let's take a look at a daily chart. So we had a high close doji, it kind of failed. We've got the weekly last conditional change, which is based off of this candle's high, which is 578. The market is 532. Obviously, if the market gets through, and I believe instead of having to wait for confirmation of a close over that high right there, this candle, the last conditional change, I believe the market gets above, believe it or not, Friday's opening range. If you trade through Friday's opening range right here, if you get back above Friday's opening range, you have a better shot to the upside and reduce your risk. So traders, if we do get up in there, look for intraday buy signals. It is starting to form a little bottom in here. Wait for confirmation. If you get one more little higher high and we get above Friday's opening range, I think we can safely look at buying wheat. Start small. Look at maybe the you're going to have to, unfortunately, this is the September contract. We're going to have to, we still have time on September, so you can look at September contract from a long position, and either we're going to come down here and post another newer low and test that level, but sometime in the next couple days, I sense that we see a bottoming pattern coming into the wheat market for an upside move. All right, real quick with gold, and the gold enters that seasonally strong period of time. In the current positions, we have per our trading room, we put on the GLD call spread because it's tough to do options on gold futures. It's just impossible. So with that said, what's my outtake for gold? We did close on a weekly basis below the prior week's low, so it could be in a consolidation as we get towards month's end. But quite frankly, this market breakout came on tremendously strong volume, and so I'm looking at maybe more chop that we see. Maybe the market can come back down and possibly test this low and that midpoint, the breakout of that candle somewhere in here. Do watch for a market breakout, a close above this last conditional change candle, and guess what? I think then we're on our way to better prices in the upside. Over the last week or so, we've seen the decline come on fairly light volume, but this has been a huge consolidation off of this big accumulation rounding bottom. You can see the volume that took place here before it just exploded to the upside. So at this point in time, if you're, I'm still looking at the October, and I'm in the October call spread because we see seasonal strength between late July going into October, and so that's what I'm measuring that position on. So with that said, I think if you get either a downside action, look for a buy signal somewhere into this support near 1290, or watch for breakouts above the 1340 handle. All right, Apple has earnings. This is a tough call. I think it's not what their earnings was as much as what their earnings sales projection might be. The market's just tried so many times to get up to that $100 new high level, which would equate to the post or pre-split 7-for-1 of $700. The trend is fairly strong here. There's no doubt about it. The trend is fairly strong. No one liked it down here. We did. And everyone loves it up here, and I kind of don't. I think there's a strong chance for between now and the next 90 days to see better pricing. The iPhone 6, there is no date coming out. Sales are kind of dismal. Competitions exists with the Samsung. I'm not an expert in the field of analyzing this technology space, but I can tell you this, the volume here and the stochastics is more neutral for me. So I have no clue how they're going to trade this market other than from a psychological aspect. People love the stock now, and so perhaps they're going to drive this to new highs. And if they do, guess what? I think there's a better play after earnings, and it for me is not to be a buyer right here. And because of the earnings event, you could get stuck if you went short right now. Amazon has earnings this week. In fact, Amazon's earnings, I think this is a tough one here because I think everyone gets stuff on eBay, and everyone gets stuff, more importantly, on Amazon, and their distribution is just amazing. So you can't really be negative on Amazon. You're still in a weekly buy, strong stochastic, strong on balance volume. Forget about it. This stock looks like we're going to probably come over time. We departed a little too much from the weekly moving averages. Let's take a look at the monthly. This market could easily come back up and test into this level up in here at 387. So that's not too bad, but I look at the stochastics hook cross here and the on balance volume for the week. It still suggests higher prices for Amazon. All right, this is about the most disappointing stock over the last 2 years. If you were in Amazon over, I mean, literally since 2012, this is where it closed in 2012 at 51. You see where we're at right now? This is amazing at 51. You've been stuck with your capital. If you owned 1,000 shares of that, $50,000 for the last literally year and a half, zero performance. Is Amazon, is it looking a little more constructive? And the answer is yes. I think that Amazon in the consumer discretionary sector, it hasn't gotten a lot of respect. It's actually got this inverse head and shoulders type sloping pattern. This could be the potential left shoulder, this could be the head, this could be the right shoulder, a breakout above this neckline, and then where do we head from there? Well, the first test is this gap. So earnings are done. We've already had earnings out of the way. So what would propel people to want to be buying eBay? Well, the consumer discretionary sector, the XLY, and more importantly, the XRT, let's take a look at the XRT, has done literally the S&P retail ETF literally since this year, as you can see from going back on a weekly chart. Let me go back to a weekly chart. It's almost the same thing. Look at this. It's if you bought the XRT at the end of 2013, no performance. 2012, different story. But for the last year or so, you haven't seen any performance in the XRT. And if we take a look at URBN, if you take a look at some of these retail apparel stores, you know, these are good names. They just haven't gone anywhere. So what I'm thinking is a name like MSFT, Microsoft, which has just absolutely gone more parabolic ballistic. If fund managers want to buy this and believe that people are going to continue to buy technology products, may I remind you that perhaps that's something that could happen. And look at this. This is SanDisk. This is just overnight. What kind of a move was SanDisk? Well, it was looking great 3 days ago, and then all of a sudden you drop almost 15%. Nice. So I think the market is showing us that there are stocks very susceptible for overnight change of hearts, so to speak. And when I look at CSCO, the company John Chambers, everyone wants to hate. When I look at a name like INTC in the semiconductor space, gap here, gap, bigger gap there, and failure to hold that momentum, I'll tell you what, the stochastics, looking at this particular market, if you think that people are now real interested in buying up here, I think fund managers, smart ones, will probably be shedding some of their positions called asset reallocation and putting some of that money to work while maybe still having some exposure into the stock. They won't sell it all, they'll just sell a portion of it and then maybe re-enter into some of these other sectors like the consumer retail apparel, because don't forget, we got kids going back to school. Now women are hitting the workforce, and a company like Ann Taylor, which if I go back to a monthly chart, here's Ann Taylor, hasn't really performed, and it's starting to form a bearish divergence pattern here on stochastics. The volume doesn't speak very well. Markets rallied on no volume, so maybe some stores aren't all cracked up to what they're supposed to be. When I take a look at Victoria's Secret parent company, Limited Brands, I note that they're near their monthly support, almost in an oversold sector, as the daily shows. But on the weekly, I mean, maybe there's some more downside here. So I'm not sure which name in the retailing space is going to win, but you know, everyone loved Macy's not that long ago, and we just felt it was a little overvalued, and now here we've come from a high of almost 60 right back to not a big deal, $4 move, but you know, more than 6% move. And I think that there could be some value in some of this retail. So what I see is sector rotation. Some of the high-flying stocks, watch out. Once you get through earnings this week, I think there'd be better plays after the earnings than trying to guess for that big kahuna move. And so this week, as I mentioned, the reason I was showing you Microsoft, because they have earnings out on Tuesday. And so Rambus, they have earnings on Monday, and Netflix has earnings. So all these big popular companies that have earnings this week is going to be quite a challenge. And I think that this pattern with Netflix, while we could see a newer high after earnings, I'd be more prone to be a credit call spread writer, because I think the market's going to have hit its maybe peak point for this time for the next 90 days. I know this was long-winded, but I do hope that everyone got insights to why we're putting out a very cautionary look in the marketplace. And, of course, the bond boys sometimes know best. Remember that. Everyone have a good trading week. We're on our seminar cruise, and we'll be back here for planning and scanning next week. Thank you.